On Monday, April 20th of 2026, Michael Saylor posted 3 words on X: think, even, bigger. The market read it as a teaser. Wall Street read it as another eccentric provocation from the man who has been called insane, reckless, and dangerously irresponsible by the same financial establishment that has been wrong about him every single quarter since August of 2020. What those 3 words actually were is a description of a mechanism, not a prediction, not a boast. A mechanical description of what was already happening inside Strategy's capital markets engine. And when the Form 8K arrived at the Securities and Exchange Commission at 12:07 p.m. Eastern Time that Monday, the number confirmed it. $2.54 billion. 34,164 Bitcoin acquired between April 13th and April 19th of 2026 at an average price of $74,395 per coin. Third largest single purchase in the company's history. Strategy's total holdings now at 815,061 Bitcoin. The headlines wrote themselves. Bloomberg ran it, CoinDesk ran it, CNBC ran it, every newsletter in your inbox ran it, and every single one of them watched the wrong number. The number is not 2.54 billion. The number is 184,939. That is the distance between where Strategy sits today and the threshold that has no precedent in the history of any fixed supply asset in human civilization. 1 million Bitcoin. 4.76% of every Bitcoin that will ever exist, held by a single corporate entity that has committed, in writing, in public SEC filings, on social media, in interviews, in shareholder presentations, to never selling. Not diversifying, not trimming, not rotating, never. There has never been a moment where a single entity was on a credible, mechanically funded, publicly documented path to permanently controlling nearly 5% of the total supply of an asset whose supply is mathematically fixed forever. Not in gold, not in silver, not in oil, not in any commodity market. This is genuinely new. And the 184,939 coins that remain before that threshold are not a rounding error. They are the most important supply side number in the Bitcoin market right now, and almost nobody is talking about them because they are too busy watching 2.54 billion. This video does something different. We are going to explain the machine that produced 2.54 billion. We are going to explain the 5 numbers inside that machine that Wall Street is not discussing. We are going to explain the institutional sequence that Saylor set in motion in 2020, and that now includes BlackRock, Fidelity, Abu Dhabi, Morgan Stanley, and Goldman Sachs. And we are going to explain why those forces converge with exchange reserves at a 7-year low, a Federal Reserve trapped between inflation and a $39 trillion debt load, and a ceasefire between the United States and Iran expiring in 48 hours to create a setup that this asset has never faced before. Numbers that are verified, mechanisms that are documented, bear cases that are presented honestly. Let us begin at the beginning. In August of 2020, a mid-sized enterprise software company based in Tysons Corner, Virginia, announced that it had converted its entire corporate treasury from cash to Bitcoin. The financial establishment's response was immediate and unified. This man has lost his mind. CNBC anchors questioned his fiduciary responsibility to shareholders. Wall Street analysts downgraded the stock. Fund managers who had never read a word of Saylor's technical writing on Bitcoin issued lengthy reports explaining why his strategy was reckless, short-sighted, and financially illiterate. The stock was trading around $10. Bitcoin was trading around $11,000. Saylor's average acquisition cost in that initial purchase was approximately $11,611 per coin. Today, Bitcoin trades near $76,000. Strategy's stock trades in the hundreds. The establishment's prediction record on this specific question, applied to the same person making the same argument over the same 6-year period, is what we would call, in technical terms, catastrophically wrong. But the more important story is not the price. The more important story is what Saylor built between August of 2020 and April of 2026. Because what he built is not a treasury position. It is not a speculative bet. It is a financial machine with no precedent in the history of corporate finance. A machine specifically designed to convert global capital market demand into permanent removal of a fixed supply asset from circulation. Understanding that machine is the prerequisite for understanding why 184,939 is the number that matters. The machine has 3 components. The first component is MSTR common stock. When investors who believe in Saylor's Bitcoin thesis buy MSTR shares at a premium to the underlying Bitcoin net asset value, Strategy can issue new shares through its at-the-market program and use the proceeds to buy Bitcoin. Every dollar raised at a premium to NAV buys more than $1 of Bitcoin at market, increasing Bitcoin per share for all existing shareholders. This is the accretive engine in its original form. The second component is the convertible bond market. In the years before STRC, Saylor raised billions through convertible notes, debt instruments that gave bondholders the option to convert into MSTR equity if the stock reached certain price targets. These notes were typically issued at 0% interest, meaning Strategy borrowed money for free in exchange for conversion optionality and deployed every dollar into Bitcoin. The third component, and the one that changed everything, is STRC. STRC stands for Stretch. Strategy's variable rate series, a perpetual preferred stock, listed on NASDAQ since July of 2025, trading near its $100 par value, paying an 11.5% annual dividend in monthly cash payments. Here's the elegance of the mechanism in 3 sentences. Investors who want high-yield stable income buy STRC at $100 per share. Strategy pays them an 11.5% annual yield in cash. Every dollar of STRC proceeds goes directly into buying Bitcoin without creating a single new MSTR common share. The BTC per share metric increases with every purchase. Common shareholders see no dilution. Strategy gets the capital. Bitcoin gets permanently removed from the liquid market. Saylor described STRC as Strategy's iPhone moment. The comparison is deliberately chosen. The iPhone did not create a new product category. It fundamentally redesigned how an existing need was met. STRC did not create a new financial instrument. It fundamentally redesigned how corporate Bitcoin accumulation is funded. Before STRC, accumulation was episodic and tied to Bitcoin's price momentum because MSTR's premium to NAV fluctuated with Bitcoin's price. When Bitcoin fell, the premium compressed, issuance became less accretive, and accumulation slowed. STRC broke that correlation entirely. STRC buyers are income investors who are indifferent to whether Bitcoin is at 70,000 or at 90,000, as long as their dividend is paid and their principal is intact. This creates a completely different and far more stable source of capital for accumulation that runs independently of Bitcoin's short-term price action. The numbers the machine produced in the week ending April 19th of 2026 are extraordinary, even by Strategy's standards. $2.18 billion raised through 21,795,389 STRC shares sold. $366 million raised through 2,165,000 MSTR common shares sold. Total capital deployed, $2.54 billion, 34,164 Bitcoin permanently acquired. On April 13th alone, Strategy recorded a historic single session, purchasing approximately 7,741 Bitcoin, then surpassed that record the following day with approximately 9,364 Bitcoin. STRC traded $1.156 billion in volume on April 13th, 46.5% above its previous daily record, and closed at its $100 par value, with what Saylor described as 1 penny of volatility. The income capital flywheel is not a theory. It is running at record velocity. Now here are the 5 numbers that matter. The numbers the headlines missed entirely. Number 1, 9.5%. That is Strategy's BTC yield year-to-date through April 19th of 2026. BTC yield is Strategy's proprietary metric measuring the percentage change in Bitcoin per fully diluted share, net of all new issuance. 9.5% means each MSTR share today represents 9.5% more Bitcoin than it did on January 1st of 2026. Not because Bitcoin's price went up, because the mechanism added more Bitcoin per share than it diluted shares. Annualized over the pace of accumulation in the first 15 weeks of 2026, 9.5% compounds to approximately 37% per year. There is no traditional financial instrument that produces this output. Not a stock buyback program, not a dividend reinvestment plan, not a convertible bond structure. This is mechanically new. Number 2, 2.05. That is the percentage per year Bitcoin needs to appreciate for Strategy's STRC dividend structure to sustain itself indefinitely. Saylor stated this publicly. The 11.5% annual dividend on STRC represents a specific obligation. If Bitcoin grows at 2.05% annually, the company can cover that obligation forever without selling a single coin and without issuing a single new MSTR common share. Bitcoin has averaged approximately 140% annual appreciation since inception. The structural sustainability of the machine does not require a Bitcoin bull market. It requires Bitcoin not to go backward by more than 2% per year. That is the floor. Everything above it is accretion. Number 3, 1.27. That is the current MNAV. Bears cite the compression from the peak of 2.6 to 2.8 in late 2024 as evidence the model is breaking. They have misunderstood the mechanism. The machine only needs MNAV above 1.0. At 1.27, every STRC-funded purchase adds Bitcoin per share at a positive accretion rate. The machine is running at below peak velocity. It is not broken. The distinction between broken and below peak velocity is the distinction between a bear case and a bear misunderstanding. Number 4, 50 billion. That is the approximate remaining authorized capital issuance capacity across all programs as of mid-April 2026. 21.6 billion in STRC capacity plus 26.73 billion in MSTR common stock. At current Bitcoin prices of $76,000 per coin, $50 billion represents the capacity to acquire approximately 657,000 additional Bitcoin. Strategy needs 184,939. The math is not close. The only constraint is execution pace and M&AV stability. Both are currently intact. The machine has the fuel. Number 5, 184,939. Everything we have built leads here. 1 million Bitcoin minus 815,061 equals 184,939. At 9,000 Bitcoin per working week, Strategy closes that gap in approximately 20 weeks, by September of 2026. That is not a projection. It is the arithmetic consequence of a documented pace applied to a documented gap. And the market is watching 2.54 billion. Now, before we get into the institutional sequence that Saylor set in motion and that has now arrived at Goldman Sachs and Morgan Stanley and Abu Dhabi, I want to take a moment for the community that makes this channel worth building. If you have made it this deep into a mechanical analysis of corporate Bitcoin treasury architecture, you are not a casual viewer. You came here for the framework, not the headline. Because we are talking about institutional capital mechanics and fixed supply mathematics today, I want to know who is actually in this room. Drop a comment below with your city, your local time right now, and what the weather looks like outside your window. Reading where this community watches from is genuinely one of the best parts of producing these deep dives. Hit the like button while you're down there and make sure you are subscribed. Your signal tells the algorithm that serious financial analysis has an audience. Now let us build the institutional sequence. Here's the pattern that nobody describes in the right order. In 2020, when Saylor converted Strategy's treasury to Bitcoin, there were no institutional vehicles for Bitcoin exposure, no spot ETF, no sovereign wealth fund disclosures, no Wall Street bank products. The only way for an institution to gain Bitcoin exposure was through Grayscale's closed-end trust at a persistent premium, or through direct self-custody, which most compliance and legal departments would not permit. Saylor was not following institutional demand. He was creating the thesis that institutional demand would eventually follow. He was not riding a wave. He was building the infrastructure that would eventually become the wave. And the sequence of what happened after him is the most important part of the story that the $2.54 billion headline missed entirely. January of 2024. The Securities and Exchange Commission approved spot Bitcoin ETSs for the first time in history after a decade of rejections. BlackRock's iShares, Bitcoin Trust, ticker IBIT, launched on January 11th of 2024 alongside 11 competing products. What happened next was without precedent in the history of exchange-traded funds. IBIT crossed $1 billion in assets within its first week of trading. It reached $50 billion in assets in 11 months. It reached $70 billion in 341 days, becoming the fastest ETF of any asset class to reach that milestone in the entire history of exchange-traded funds. For context, State Street's SPDR Gold shares, the previous record holder, took 1,691 days to reach the same benchmark. IBIT did it nearly 5 times faster. BlackRock CEO Larry Fink, who had called Bitcoin an index of money laundering as recently as 2017, told investors directly that IBIT was the fastest growing ETF in the history of ETFs. That is not a speculative observation. That is a fiduciary statement with $13 trillion behind it. But the IBIT story is not only about the asset under management numbers. It is about what those numbers represent in terms of the institutional adoption sequence. The capital flowing into IBIT in 2024 and 2025 was not retail money chasing a headline. It was institutional capital from endowments, sovereign wealth funds, pension managers, and family offices that had been waiting for a regulated vehicle with the custody, compliance, and reporting infrastructure their mandates required. Saylor built the thesis in 2020. The SEC created the vehicle in 2024. The institutions moved when the vehicle was available, not before. The sequence is not coincidental. It is the documented pattern of how institutional capital enters new asset classes, and it is precisely half complete. February of 2026. Mubadala Investment Company, the sovereign wealth fund of Abu Dhabi, managing approximately $300 billion in assets, filed a 13F disclosure with the Securities and Exchange Commission confirming it held 12,702,323 shares of BlackRock's IBIT. At December 31st of 2025 valuations, that position was worth approximately $630 million. More importantly, the filing showed Mubadala had grown its Bitcoin ETF position by 46% in a single quarter, buying aggressively into a Bitcoin market that had already corrected significantly from its all-time high. The Abu Dhabi Investment Council, an independently run unit of Mubadala, simultaneously disclosed an additional position of 8.2 million IBIT shares. Together, the two Abu Dhabi entities held a combined position exceeding $1 billion at peak valuations. Separately, Goldman Sachs filed a 13F the same season, disclosing over $1 billion in Bitcoin ETF holdings through client allocation products. What Mubadala's disclosure represents is not a large dollar amount relative to its $300 billion total asset base. It represents the first public confirmation that a Gulf sovereign wealth fund, the same category of institution that runs the petrodollar recycling system that has underpinned dollar reserve status for 50 years, has made a deliberate analyzed decision to hold Bitcoin as a reserve asset. This is not an ideological statement. This is a portfolio management decision made by people who have run the same fiscal analysis this channel has documented across multiple videos. They looked at dollar reserve trajectories. They looked at the debt structure. They looked at the petrodollar system under stress from the Iran conflict. And they allocated, not because Bitcoin is exciting, because holding $300 billion primarily in dollar-denominated assets when the dollar's structural support mechanisms are visibly weakening is precisely the wrong position. That is the sentence that explains every 13F filing from every sovereign wealth fund that will follow Mubadala over the next 24 months. April 8th of 2026. Morgan Stanley launched MSBT, the Morgan Stanley Bitcoin Trust, on NYSE Arca. MSBT became the first spot Bitcoin ETF issued by a major United States bank. Not an asset manager, not an ETF specialist, a bank. With 16,000 financial advisors in its wealth management network and $3.5 trillion in assets under management, Morgan Stanley had previously recommended clients allocate 2 to 4% of their portfolios to crypto through third-party products. Now it was directing that capital to its own product at an expense ratio of 0.14%, the cheapest spot Bitcoin ETF in the market. MSBT drew $33.9 million on its first day and crossed $100 million in its first week, making it Morgan Stanley's most successful ETF launch to date. The word bank matters here, not asset manager, not ETF specialist. Bank. When the first major United States bank issues a spot Bitcoin ETF, it is not making a speculative bet. It is responding to client demand that has reached a threshold where the reputational, legal, and compliance cost of not offering the product exceeds the cost of offering it. April 14th of 2026. Goldman Sachs filed a registration statement with the Securities and Exchange Commission for the Goldman Sachs Bitcoin Premium Income ETF. The proposed fund would invest at least 80% of net assets in Bitcoin-linked instruments, primarily IBIT and Fidelity's FBTC, and would sell covered call options on those positions to generate monthly income for shareholders. Bloomberg's senior ETF analyst Eric Balchunas described the product as boomer candy, noting that Goldman's distribution network and institutional client relationships could allow it to leapfrog BlackRock's competing product. On April 13th, the day before the Goldman filing became public, Bitcoin ETFs collectively took in $411 million in a single day. Not a single ETF recorded an outflow. Goldman Sachs, the bank that invented and perfected the concept of sophisticated financial product development for institutional clients, had decided that Bitcoin income products were worth the regulatory, legal, compliance, and reputational investment required to file with the SEC. That decision does not happen at Goldman Sachs without years of internal analysis, client surveys, or risk committee approvals, and board sign-off. It happens when the institutional demand is not only real but large enough to justify the full weight of the Goldman product development apparatus. Now add the ETF market totals because those numbers tell the complete story. Total assets under management across U.S. spot Bitcoin ETFs reached $96.5 billion in April of 2026, the highest level since mid-March. Total cumulative net inflows since the January 2024 launch exceeded $53 billion. BlackRock's IBIT alone held 802,824 Bitcoin worth approximately $61 billion at current prices, more than any other single ETF or institutional vehicle in the world, until Strategy's April 20th purchase pushed it to 815,061 coins and took the top spot back. US spot Bitcoin ETFs as a category hold more than 1.3 million Bitcoin. The institutional infrastructure that did not exist when Saylor started buying in 2020 now holds 1.3 million coins and is expanding with new products. From Morgan Stanley, Goldman Sachs, and every major Wall Street institution, that has watched BlackRock print $100 million per year in ETF fees from a product that launched 24 months ago. Here is the sequence stated plainly for the first time in this analysis. Saylor built the thesis in 2020. He held through the laughter of the establishment. He held through the crashes. He held through FTX. He held through every declared death of Bitcoin and every revised downgrade of his company by analysts who were wrong. BlackRock built the vehicle in 2024 because its clients demanded access, and the regulatory environment finally permitted it. Abu Dhabi's sovereign wealth fund allocated in 2025 and 2026 because the vehicle was now compliant with its mandate, and the dollar's structural trajectory was increasingly clear to anyone running a $300 billion portfolio. Morgan Stanley issued its own product in April of 2026 because 16,000 financial advisors need a product with their own firm's name on it to channel client allocations. Goldman Sachs filed in April of 2026 because when Morgan Stanley moves, Goldman does not stay still. And Saylor bought $2.54 billion more in the same week. All of this was happening because the machine he built has $50 billion in remaining firepower and 184,939 coins left to buy. This is the sequence, not a prediction, not speculation. A documented sequence of institutional adoption playing out in public filings, ETF prospectuses, SEC disclosures, and Monday morning Form 8K filings. And it is not complete. Now let us connect the machine and the institutional sequence to the supply side that makes the convergence historically singular. Bitcoin exchange reserves as of April 2026 have fallen to approximately 2.21 million Bitcoin, a 7-year low, down from over 3.2 million in 2023. 1 million coins have moved off exchanges into private custody, into ETF vaults, into corporate treasuries in under 3 years. At the same time, whale wallets holding 1,000 or more Bitcoin grew from 2,082 in December of 2025 to 2,140 by April 2026, accumulating 270,000 Bitcoin in 30 days, the largest monthly whale accumulation since 2013. The supply structure at the moment strategy accelerates toward the 1 million coin target is the tightest it has ever been in this asset's history. In March of 2026 alone, Strategy purchased 46,233 Bitcoin, while the global Bitcoin mining network produced approximately 16,200 coins in the same month. Strategy absorbed 3 times the entire planet's new Bitcoin supply in a single month. When the 184,939 coin target intersects with exchange reserves at 2.21 million, against a daily mining output of 450 coins, the supply arithmetic produces one conclusion. The coins do not exist on exchanges in sufficient quantity to absorb the demand without moving the price. Now let us connect the micro to the macro. The Federal Reserve sits at approximately $6.5 trillion on its balance sheet. In 2020, it expanded by nearly $5 trillion in approximately 2 years, and Bitcoin during that expansion went from $5,000 to $69,000. That correlation is documented in peer-reviewed research by Dr. Michael Howell of Cross Border Capital, who found that 40 to 45% of Bitcoin's systematic price movements are explained by global liquidity dynamics, with liquidity leading Bitcoin's price by 11 to 13 weeks. The Congressional Budget Office projected a $1.9 trillion federal deficit for fiscal year 2026 before any war expenditure. Interest payments on the national debt now exceed $1 trillion annually. The Iran conflict costs approximately $1 billion per day. The ceasefire expires Wednesday evening at 7:50 p.m. Eastern. Every scenario from Wednesday night, resolution, escalation, or ground troops, ends in the same fiscal place for the United States dollar. And that fiscal place is one that the largest asset managers on the planet, BlackRock, Goldman Sachs, Morgan Stanley, and the sovereign wealth funds of the Gulf, have already begun positioning for through the only fixed supply asset that exists outside every government's monetary jurisdiction. The bear case for this thesis has 3 components and deserves full engagement. The first is MENAV collapse below 1.0. If Bitcoin falls significantly below Strategy's average cost of $75,527 and stays there, the machine stalls. This happened briefly in February of 2026. Strategy responded by buying $1 billion more. The second is the dividend obligation of approximately $1.24 billion annually against a $2.25 billion cash reserve providing approximately 30 months of runway. The third is concentration risk. Strategy holds 76% of all Bitcoin owned by publicly traded companies, and its own investor presentation confirms it would begin selling if its market cap falls and remains below the value of its holdings. Prediction markets assign 13% probability to that scenario in 2026, down from 30% in February. These risks are real. They have been real since 2020. The establishment cited each of them at every drawdown. At every drawdown, Saylor bought more. And at every drawdown, the institutional sequence that started with his purchase moved one step forward. BlackRock, Fidelity, Abu Dhabi, Morgan Stanley, Goldman Sachs. The sequence has a direction. It does not have a pause button. The number everyone is watching is 2.54 billion. The number that moves the market is 184,939. At 9,000 Bitcoin per working week, that number reaches zero in approximately 20 weeks. Against exchange reserves at a 7-year low, against a Federal Reserve meeting in 8 days with a trapped policy stance, against a ceasefire expiring in 48 hours, against the first major U.S. bank Bitcoin ETF launched 13 days ago, against a Goldman Sachs filing that triggered $411 million in single-day ETF inflows, against a global institutional adoption sequence that started with one man at Tyson's Corner buying $11,000 Bitcoin and now includes two of the largest asset managers in human history and a sovereign wealth fund that manages the petrodollar recycling system Saylor has been arguing would eventually break. Think even bigger was not a social media post. It was a status report. Drop 3 letters in the comments if you made it to the end of this analysis. I see the game, not as a code. As confirmation that you understand the mechanism, that you understand the transaction size was never the signal. The institutional sequence was the signal. The remaining coins were the signal. The 11 to 13 week lag between what is happening in Strategy's capital markets engine right now and what happens to the Bitcoin price next is the signal. That lag is the window, and the window is open right now. Subscribe if you are not subscribed. Share this with one person who is still staring at 2.54 billion and thinking they understand what is happening. Because that number was last week. The number that matters this week, next week, and every week until September of 2026 is 184,939, and it gets smaller every Monday morning.